More on the markets and the Fed. Want to bring in Jeremy Siegel, Professor Emeritus of Finance at the University of Pennsylvania's Wharton School of Business, Chief Economist at Wisdom Tree. Good morning to you. We heard what Jay Powell had to say yesterday. I don't know if you're a believer that the next time he even touches rates that he's lowering them or he's maybe raising them.
I don't think he's raising them. Odds are overwhelming against that. I thought it was a very good news conference. I mean, the only thing I quibble with is he's still trying to blame inflation 3 years ago on supply side. Well, when I think it was an excessive burst of money and the stimulus. But nonetheless, I think he got it absolutely right. I think, in fact, there will be rate cuts. Not as many, certainly, as we thought 6 months ago. But when I look at the factors that have made this inflation sticky over the last 3-4 months, namely rentals, car insurance, we saw a break in commodity prices this week for the first time in 2 months. That's a good sign. So forward-looking, I do think there are very favorable signs that inflation is going to calm down.
What is your sense of when you think about the stock market and you think about stocks in particular? We've seen the tech companies have been big winners. That's been clear. We talked just earlier about Starbucks. We've talked about McDonald's. We've talked about even Andy Jassy, even though they've had great success in large part. He's talked about the trade down that he's seeing among consumers. How worried are you about that?
I'm not too worried. The sensitive indicators I see are not yet turning downward. You do see some caution and resistance to higher prices. I think that's one of the things that's going to keep that inflation under control. Starbucks prices, I mean, it's great quality, but it's high, and people are saying, hey, I'm not necessarily going to go for that. I think that is one of the factors that's going to keep inflation lower. Listen, I mean, consumers are going to be thrifty, but I don't see a downturn. I mean, the sensitive indicators, obviously Friday we're going to get the employment report. I think actually, in less than half an hour we get that the unemployment claims. Yep. I like to look at that as a weekly indicator. So the spending weekly indicators I see do not see a decisive weakening. I still think this economy is moving along 2-3% real GDP rate.
And then when you think, though, about the stock market, you're walking into an election cycle. I mean, we're already in it, obviously. But given the volatility that some people are projecting, I don't know where you think we end the year.
I think we end the year up. I don't think it's going to be as good as last year. I mean, we're getting spoiled. We have to realize, long term, the market's up around 7% a year on average. We get 20, and people keep on thinking, boy, if it's less than that, I'm going to be disappointed. 7-8% return with even a dividend of 1 and 2 is still definitely better than bonds at this point. So I still think stocks are going to be the winner.
Jeremy, one of the things you brought up again and again was how long the Fed stayed at zero. You'll never forgive him for that, I don't think.
No,
and
I will never forgive him for that.
That was a miscalculation on inflation. And the point you just made that you're convinced, you've always thought it was demand engendered, not supply engendered. Yeah. Well, the stimulus is still there. None of these programs are finished. And we keep getting new ones. We keep, some art school that people had to borrow. We're going to pay off that $6 billion. There's a lot we're still doing. Why don't you think the Fed could be once again wrong about the threat of inflation? Because the demand push is that you talk about is still present. How do you know for sure that it's under control?
Well, it's not at the degree, Joe, is what we had. We had $9+ trillion of stimulus within, 2 years of the onset of the COVID crisis. Now, the first package, we could say, when no one knew what was going to happen, okay. And then we had a second Trump package, not really. And then we had huge Biden packages as the economy was roaring back, in which the Fed just printed money and gave it right to the government to spend on all that. That's over. Now, certainly, the infrastructure is a long-term and that is still going on. And of course, we still have a lot of spending on all those other things that we kept on going. But the big bulk of the splurge of spending is gone. And that's what, and I look at the money supply, and that's been very stable over the last 2 years. So we're not in that situation that we were in 2020, 2021, which of course I think was the real cause of the burst of inflation we had.